Three separate financial institutions have all looked at the exact same engineering firm, reached the exact same bullish conclusion, and yet come up with target prices that are worlds apart. We are looking at a sharp corporate disagreement on the board, a major infrastructure pipeline in the United States, and an ongoing review that the market is completely ignoring. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. Before we get into the specific brokerages, remember that this roundup comes directly from me, Angela, your market correspondent. My role here is to recap the broader market conversation, surface the operational tensions, and point out exactly where the institutional analysts are disagreeing. I am not applying Iggy's regular forensic filters or zone verdicts today, but my journalist eye is focused on exactly what the raw numbers are not telling you. The company under the microscope is CSE Global, an engineering systems provider listed on the Singapore Exchange that operates across automation, telecommunications, and electrification. The stock has caught major market attention after a massive correction in its share price. This drop followed the sudden resignation of its lead independent director and the public disclosures around an ongoing strategic review. Three separate houses have just updated their coverage to assess if this governance friction changes the long-term thesis. First up is RHB Research, where analyst Alfie Yeo suggests that the recent share price volatility should finally begin to taper off. The house notes that the sharp correction on June 4th and 5th was driven directly by the resignation of independent director Tan Cheon Kong. His departure left a temporary governance overhang after a very public disagreement with the chairman, Eugene Lai, over the company's operational direction and the pace of the ongoing strategic review. To manage that review, Jefferies Singapore has been officially appointed as the financial advisor. To understand the boardroom friction, we have to look at the compliance numbers. Tan Cheon Kong stepped down on June 2nd, vacating his roles as Audit Committee Chair and Lead Independent Director. However, despite this high-profile departure, 4 independent directors still remain on the 7-member board. This keeps the company fully compliant with the Singapore Exchange rules, which require at least 2 independent directors constituting at least 1/3 of the board, and interim arrangements are already handling the committees while former replacements are found. The core of the bullish case for RHB rests on an estimated $1.5 billion of orders from Amazon over the next 5 years. This pipeline is tied tightly to electrification infrastructure work for Amazon's massive data centers in the United States. On the back of this huge backlog, RHB projects a compound annual growth rate in earnings of 27% from financial years 2025 to 2028. They maintain a buy rating with a target price of $1.94 Singapore cents, implying roughly 42% upside, and an estimated dividend yield of about 3% for financial year 2027. Looking at the valuation, the stock trades at around 20 times forward price to earnings, which sits below that projected 27% earnings growth rate, giving it a price-earnings to growth ratio of under 1. RHB does apply a 2% discount to its intrinsic value estimate because the company's environmental, social, and governance score of 3.0 sits just below the Singapore median of 3.1. The key operational risks to watch here are unexpected project cost overruns, the chance that Amazon does not fully deliver the projected pipeline, and any negative findings from the strategic review. This brings us to my first major observation on this setup. While all 3 financial institutions share an identical buy rating, their actual price targets show a deeply divided view of the future. The massive gap between the lowest target and the highest target is not a simple rounding error. It represents completely different assumptions about how efficiently that United States infrastructure pipeline will actually convert into bottom-line earnings. When the analysts agree on the direction but fight this sharply on the final value, it means the underlying models are doing some very heavy lifting. Turning to our second institutional note, UOB Kay Hian takes a slightly different angle, framing this entire boardroom dispute as a standard governance transition rather than any sign of structural operational decline. Analysts John Chong and Heidi Mo maintain their buy rating with a target price of $1.79 Singapore cents, arguing very directly that the core business operations of the engineering group remain fully intact despite the public noise. UOB Kay Hian details exactly how the boardroom friction broke out, drawing from the official clarification sent to Singapore Exchange Regulation. The tension began during a proposed board refresh, where the chairman wanted to bring in a new independent director with deeper mergers and acquisitions experience. The outgoing lead independent director declined to step down early, citing his specific mandate from shareholders, and eventually resigned on June 2nd due to a breakdown in trust. Differing views on the pace of due diligence for the Jefferies review added to the heat, but all key committees still retain their independent majorities. On the actual operational front, the numbers show zero signs of commercial deterioration. First quarter revenue grew by 29% year-on-year to 265 million Singapore dollars, while order intake surged by 75% over the same period. The total order book stands at a massive 716 million Singapore dollars. The report also highlights that Heliconia, a major Temasek investment platform, has remained a stable long-term shareholder since 2015, adding a layer of institutional stability to the background. The near-term narrative for UOB Kay Hian is a story of two halves. The first half of this year is expected to look softer due to elevated material costs, startup expenses for a brand new 241,000 square foot electrification facility, and the final closeout of several municipal renewables projects. And here is the part that matters. A sharp operational recovery is anticipated in the second half of the year as that new facility normalizes and the huge backlog starts converting into recognized revenue. Their target price of $1.79 Singapore cents is pegged to 29 times the 2027 forecast price to earnings ratio. The key monitoring markers highlighted by the house focus entirely on execution and governance stability. Investors need to watch the overall pace and caliber of the new independent board appointments, any potential friction between the reconstituted board and active management, and the ongoing quality of corporate disclosures. Most importantly, the progress of that Jefferies-led strategic review remains a central watch point as it moves through its due diligence phases. Our third institutional perspective comes from Maybank Research, where analyst Jarek Seed looks at the recent correction very differently. He characterizes the sharp 20% drop in the share price as a highly compelling entry point for retail investors. Maybank maintains a buy rating with the highest target price in the market at $2.25 Singapore cents, positioning the company as a pure direct proxy to the multi-year artificial intelligence data center capital expenditure cycle, happening right now in the United States. Maybank's execution thesis relies heavily on an aggressive production ramp-up. They expect the second half of this year to be materially stronger than the first half, driven entirely by work for a major artificial intelligence data center client at the newly leased facility. While profit margins are facing short-term pressure from upfront labor recruitment and rental costs, those numbers are projected to improve dramatically as facility utilization rises. If execution goes smoothly, this primary client could unlock additional project phases very quickly. There are also strong internal confidence signals appearing in the data. The Chief Executive Officer marginally increased his personal stake from 3.70% to 3.71% through a scrip dividend election, showing clear alignment with shareholders. Commercially, the group is planning to more than triple its entire operational capacity by 2028, and Maybank expects them to secure at least one additional major data center client by the first quarter of next year to further support this international build-out. When we look at these volatile setups on the Singapore Exchange, the line between finding a safe long-term sanctuary and falling directly into a dangerous yield trap is regularly decided in a single trading session. While the broader market is busy reading yesterday's public news updates, Our private community is already deep inside the financial statements, analyzing the next operational setup together in real time. If you want to move away from being the exit liquidity for institutional players and start acting like an analyst, joining Iggy's elite investors changes the entire equation. Members receive our complete forensic breakdowns, zero-day access to every report before the general public, and our full specialized watch list. It gives you the institutional-grade tools built directly around our core auditing process, ensuring you see the structural data before the market opens and moves. Bringing the big picture back together, all three financial brokerages are in absolute agreement on the core operational reality. They view the recent share price crash as a massive overreaction to a standard governance transition rather than any form of deep commercial weakness. With a substantial backlog fully intact and structural positioning within the massive United States data center expansion, all three houses view the long-term fundamentals as completely uncompromised. The divergence is found entirely in how they weight the risks and value the pipeline. RHB Research highlights client concentration risks and applies an environmental, social and governance discount to arrive at $1.94 Singapore cents. UOB Koi Hian focuses heavily on the boardroom friction and near-term margin pressures from facility startup costs for their target of $1.79 Singapore cents. Maybank Research focuses almost exclusively on the massive capacity tripling and the multi-year artificial intelligence infrastructure tailwinds to justify their high target of $2.25 Singapore cents. This brings us to the final critical observation from Angela that every retail investor needs to consider. The window is already open. None of these three institutional reports explicitly model out what a negative or completely inconclusive outcome from the Jefferies strategic review would actually mean for their earnings forecast. The review is treated as simple background context for the governance friction rather than an active variable inside their valuations. That is a standard choice for an early-stage review. But it means the single largest structural unknown sitting right beneath three highly optimistic price targets remains completely unquantified. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get zero-day access. Link in the description. If you want to protect your capital from these unquantified boardroom risks, making sure you see our breakdowns during the 7-day embargo window is vital. Join Iggy's elite investors today through the link right below to get the full forensic data. The information contained in this presentation is for educational and informational purposes only. It does not constitute financial, investment, legal or tax advice. Past performance is not indicative of future results. All investments involve risk, including the possible loss of principal. Independent research and due diligence should be conducted before making any investment decisions.